Hey everyone, and welcome back to the channel. Today, we're diving deep into the Singapore real estate investment trust market, which has seen some significant shifts lately. If you're invested in S-REITs or considering it, you'll want to pay close attention, because what's happening is more complex than it might seem. We're going to break down who's selling, why, and what this means for the future of S-REITs, including where the real opportunities might lie. If you haven't already subscribed to our channel, please subscribe to our channel. Your support truly makes a difference, enabling us to produce more stock and fundamental analysis content. Please note that the content presented in this video is for informational purposes only and does not constitute investment advice. We strongly recommend that you seek proper guidance from a qualified financial advisor before making any investment decisions. Let's start with the big picture. Institutional investors have been net sellers in the S-REIT market, particularly in early June 2025. This isn't a new phenomenon. It's a continuation of a trend observed earlier in the year. Quantifying this, CapitaLand Integrated Commercial Trust bore the brunt of this selling pressure, recording net sales of SGD 13.6 million during the week of June 2, 2025. Another major player, Mapletree Industrial Trust, or MIT, also saw substantial institutional divestment in late May and early June. In fact, the aggregate institutional outflow across the Singapore market had already reached 1.77 billion Singapore dollars for the year up to April 16, 2025. This shows a more systemic shift in institutional sentiment. Now, here's a fascinating contrast. While institutional investors were offloading, retail investors showed a clear divergence in preferences. For instance, retail investors actively supported Mapletree Industrial Trust with an SGD 10.6 million inflow during the week of May 19, 2025. This suggests that these two investor segments operate with different investment horizons, risk appetites, or interpretations of market signals. So, why are institutions selling? It's not one single reason, but a confluence of interconnected factors. First, let's talk about the macroeconomic environment and global trade tensions. Persistent global trade policy uncertainties, including new US tariffs, have reignited concerns about trade protectionism and its impact on global supply chains. The Trump tariff tantrum in April 2025 directly led to selling pressure on S-REITs. Even with a reported US-China trade truce, Singapore's manufacturing PMI remained in contraction in May 2025 at 49.7, highlighting persistent weakness and affecting sectors like logistics and industrial REITs, especially those with China exposure like Mapletree Logistics Trust. Next, interest rate dynamics and refinancing costs are a major factor. The prolonged high interest rate environment has significantly elevated the cost of debt refinancing for S-REITs. Some REITs, like Frasers Logistics and Commercial Trust, saw a substantial 13.8% fall in distribution per unit due to a sharp spike in finance costs. While local interest rates, specifically the Singapore overnight rate average, have moderated slightly, they remain sticky, easing slower than expected. This impacts refinancing costs for floating rate debt. There's also intensified competition for capital from yield-focused alternatives like fixed deposits and government bonds, which offer competitive yields. Third, a portion of this selling is simply strategic portfolio rebalancing and profit-taking. The SGD 13.6 million outflow from CICT is explicitly attributed to profit-taking or broader portfolio rebalancing. REIT managers themselves are actively engaged in portfolio reconstitution, including strategic acquisitions like CapitaLand Ascendas REIT's data center purchase, and divestments like Manorlife US REIT's property sale to manage debt. There's also a visible shift by REIT managers towards reducing capital top-ups and increasing cash-based management fees, aiming for more sustainable payouts, which aligns with institutional investor demands. Finally, the regulatory framework and global market competitiveness play a role. Singapore's 50% aggregate leverage limit for S-REITs hampers their ability to compete effectively against global competitors, as other mature REIT jurisdictions don't impose such prescriptive limits. This can lead institutional investors to reallocate capital elsewhere. The Monetary Authority of Singapore is aware of this and is actively pursuing reforms, including the 5 billion Singapore dollar equity development program, to attract institutional investment and enhance market appeal. Despite the selling, a closer look reveals a nuanced picture with significant sectoral divergence and underlying resilience. Many S-REIT subsectors, especially those with strong domestic exposure, continue to demonstrate fundamental strength. Singapore office sector showed broadly resilient performance in Q1 2025, with positive rental reversions and high occupancy rates. For example, Keppel REIT reported a 10.6% positive rental reversion and 96.3% occupancy, and CICT saw 5.4% rental reversion for its office portfolio. A limited supply of new office space from 2025 to 2027 is expected to support rental stability. Retail sector generally held up well, with strong rental reversions. Fraser's Centrepoint Trust posted a plus 9.0% rental reversion in 1H FY25, and Vivo City under Impact reported an impressive 16.8% rental reversion. Data centers have been standout performers. Keppel DC REIT delivered 14.2% year-on-year DPU growth in Q1 2025. However, it's not all sunshine. The logistics and industrial sector faces challenges, notably Mapletree Logistics Trust reporting a minus 9.4% rental reversion in China due to trade war concerns. The hospitality sector also exhibited mixed performance. Now, let's talk about valuations. Despite institutional outflows, S-REITs generally present attractive valuations. The sector is broadly considered undervalued, trading at an average of 0.83x price to book. A significant proportion, 2/3 of S-REITs, are currently trading below their net asset value. Forecasted FY25F yields are around 6.2%, or approximately 5.5% when adjusted for capital top-ups. Even at this adjusted level, S-REITs offer the highest yield spreads among developed Asian REIT markets. For example, undervalued REITs based on price NAV include Lippo Malls Indonesia Retail Trust at 0.18x, Prime US REIT at 0.25x, and Manulife US REIT at 0.30x. This suggests a potential valuation disconnect. The institutional outflows might not be solely due to a fundamental deterioration, but rather a repricing of risk, liquidity-driven moves, or broader portfolio rebalancing. So, what's the outlook? The broader picture for S-REITs remains positive, underpinned by expectations of descending SGD interest rates and resilient economic growth in 2025. However, significant volatility is anticipated in the near term due to global trade tensions and the prospect of higher for longer global interest rates. Institutional investors appear to be taking a wait-and-see approach, prioritizing capital preservation. What could drive a recovery or continued pressure? Recovery catalysts: accelerated interest rate cuts by the US Federal Reserve and continued easing of SGD rates. Improved global economic growth and a clearer resolution of trade tensions. Successful capital management, including accretive acquisitions and asset recycling by REIT managers. Increased investor allocation, as the sector is currently underexposed. The ongoing shift by REIT managers to more sustainable DPU models, such as cash-backed management fees, is expected to improve earnings visibility and long-term attractiveness. Continued pressure factors: persistent inflation leading to central banks maintaining elevated interest rates for longer. A protracted trade war depressing demand for certain property types. Slower than expected global growth impacting rental income and occupancy rates. If SORA rates ease slower than anticipated, continuing to pressure refinancing costs. Escalating geopolitical tensions disrupting trade routes and supply chains. In conclusion, the institutional selling in S-REITs in June 2025 is a complex story driven by macroeconomic factors, interest rate dynamics, portfolio adjustments, and regulatory aspects. It's a continuation of a trend, contrasting with retail investor behavior. However, it's crucial to remember that this isn't an indiscriminate sell-off. Many subsectors, particularly Singapore office, retail, and data centers, are showing strong fundamentals with high occupancy rates and positive rental reversions. The sector generally trades at attractive valuations, with many REITs below their net asset value. For long-term, value-oriented investors, the current market conditions may present selective opportunities. Fundamentally strong REITs with resilient underlying assets, strong tenant bases, and proactive management teams that are shifting towards more sustainable payout models are well positioned to weather the storm. As macroeconomic clarity improves and interest rate tailwinds strengthen, these quality S-REITs are likely to see renewed institutional interest. It's a nuanced market, and understanding these underlying drivers and individual REIT fundamentals is key to navigating it successfully. If you found this breakdown helpful, please hit that like button, share this video, and subscribe for more in-depth market analysis. Let us know in the comments what S-REITs you're watching. Thanks for watching, and I'll see you in the next video.